G'day, it's Stefan Angelini from Angel Advisory. It's the 13th of February, and today on this little economic update, we are talking about inflation, financial pressures in Australia, some things about Australian housing prices, asset returns this calendar year, China's reopening, and then some lessons some of you people can face from the Super Bowl. People always ask why we do these updates. Well, simply we manage people's money for a living, so we consume a whole lot of content. So why not share in a few minutes all the content we've learned from overnight or over the weekend in this case? So to kick it off today, as we get into it, just letting you know that this is just general information. Please don't consider it as personal advice. And if you want personal advice, please go and consult your licensed financial planner. Now, last week, things closed a little lower after a really heated January. So, it's as expected that markets would have come off the heat a little bit. As we look to just asset classes and their returns around the world, equities like US equities, emerging markets have all returned 10% plus for the calendar year to date. So January and the start of Feb. So some huge returns already that we're seeing in a bit of a comeback after markets felt a fair bit of pain in 2022. As we go to talking about inflation, some good news is that energy and goods prices are starting to come down a little bit. However, the issue that's going to keep inflation high is now wage growth. So wage growth is an input to inflation and inflationary figures. And as you'll see, people are getting pay rises because there's simply not enough people that have jobs. What you can see is that especially in areas like Europe and the US, wage growth is going to continue rising, which will cause inflation to stay high in their tight labor markets. And now, if you are a fan of a very smart person, a man by the name of Christopher Joy from Coolabah Capital is an amazing commentator, and it was predicted most of the housing downturns, especially this one, and has gone on to say in one of his recent articles in The Age and to Livewire that he expects about 15% of borrowers to have a negative cash flow after accounting in mortgage repayments and essential living expenses once rates hit 3.6%. So given we're at 3.35, if another 0.25% rate increase comes, it's going to be a lot of Australia that face housing stress. Now, pointing out that Australians do have a lot of savings, a lot of pent-up savings as a result of this. So we'll just see what the roll-off of fixed price mortgages in June looks like when it does come. But he's saying there might be a bit of hurt for Australians. Now, importantly, on marketindex.com.au, they posted some realestate.com.au figures, and their revenue has increased dramatically. Even though, just letting you know, home values have fallen by 8.9% since peaking in April of 2022. Now, this is the fastest and largest decline since research began in 1980. So, look, it's been pretty hard and fast, but there was quite an increase last year. There's a lot of people with repayment stress, so house prices will continue to come off the boil. Let's go around the world from a recent update from Munro Partners, who are an international fund manager. They were talking about China and the reopening of China. So now China are out. They're not in lockdowns anymore. We're in a lot of lockdowns. And as you can see in Australia, if you compare it to China, we're in lockdowns for a little while. We had a lot of savings. When people got out, they spent and they traveled. Anyone you know around you that has happened to, China have been locked down for basically 2 years. There's $900 billion of pent-up savings there. Now, what are they going to do? Most likely, they're going to spend and they're going to travel. So if they travel, they might come to places like Australia. If they spend, they're normally going to spend on luxury goods or items. Now, this might cause further inflationary pressures around the world because China is now out. Whether or not you start investing back into China directly is still a bit iffy, simply because of government regulation. And now regulation in China is almost like a bit of the resources cycle here in Australia. There's government regulation, then there's none. There's government regulation, then there's none. China are coming off a pretty hot period of a lot of government regulation and red tape. So we'll see what that means for a lot of their companies and stocks within that country. Now let's have a bit of fun. Did you know that the Super Bowl is a huge betting event? So it is predicted that around 50 million people will bet on the Super Bowl that's getting played today. And that's about $16 billion is going to be bet on it. So it's a huge event. But let's have a look at what playing NFL, and in particular the Super Bowl, what lessons it has for investors that might be like you and me. Now, this was after an update from Kathy Leanne from investor.com. She said, number one, if you're an investor, prepare and plan and do your research. Number two, be adaptable and flexible. So always change your investment strategy with the game. Number 3, be patient and disciplined. It's not a quick race. Have a long-term goal. And importantly, number 4, take calculated risks. So if you don't take risks, you're not going to grow. Investing is a risk in itself, but be calculated in what you do and how you do it. Number 5, have long-term goals. So within the Super Bowl, people don't try and win one game, they try and win a season. So that's the same with investing. Focus on the long term. Number 3, take breaks. Number 6, take breaks. Take breaks a lot, recalibrate, rethink your position, have a look at your own personal situation and go from there. Hopefully it's a great day. If you're watching the Super Bowl, all the best. Go Chiefs. Have a great day. See you later. Bye.